Before we start, quick favor. If this video helps you think more clearly about your money, hit the like button and subscribe. For you, it's a small click. For me, it really helps. All right, let's talk honestly. Most people think a 401k is a retirement plan. It's not. It's a tax deferral tool, and for many people, it quietly turns into a financial time bomb. And I'm not saying 401k's are evil. I'm saying most people use them blindly, and that's where the danger starts. Let's break this down calmly, like adults. A 401k was designed in the late 1970s, when the economic world looked very different. Stable jobs, rising wages, real pensions, shorter lifespans, lower healthcare costs. Back then, deferring taxes made sense. Today, different world, different risks. The first problem, tax risk. People love the phrase tax deferred. It sounds smart. It sounds responsible. But here's what it really means. You're not avoiding taxes. You're postponing them into the future, and the future is uncertain. Every dollar you put into a traditional 401k comes out as ordinary income. Not capital gains, not some special rate, regular income tax. And here's the uncomfortable part. Most people assume they'll be in a lower tax bracket in retirement. That assumption is becoming weaker every year. Governments are broke. Debt is exploding. Social Security is underfunded. Healthcare costs are rising. If taxes go up, and historically, after high debt periods, they usually do, your tax-deferred money becomes a tax trap. You don't control the tax rate. You only control when you pay, and with a 401k, even that is limited. Which brings me to the second problem, lack of control. Your money in a 401k is not flexible money. Withdraw it before 59 and a half. You pay income tax plus a 10% penalty. Need it for an emergency, an opportunity, a health issue, a family crisis? Too bad. The rules don't care about your life. Yes, there are exceptions. Hardship withdrawals, loans, fine print. But the core truth remains. Your capital is locked when flexibility matters most. And flexibility is safety. The third problem, fees that quietly eat your future. Most people underestimate fees because they sound small. 1% doesn't matter. 2% is normal. No, over 30 or 40 years, fees are brutal. According to multiple studies, a 1% annual fee can reduce your final retirement balance by 20 to 30%. A 2% fee can wipe out nearly half. And here's the kicker. Many 401k plans don't clearly show total fees. Administrative fees, fund expense ratios, advisor fees. They're buried. You're paying, you just don't feel it yet. The fourth problem, forced market exposure at the wrong time. This one destroys people quietly. Most 401k's are heavily invested in the stock market, especially target date funds. Sounds reasonable, but here's the issue. You don't choose when markets crash. If you're 60 and the market drops 35%, like in 2008, your portfolio doesn't just drop. Your timeline collapses. You don't have 20 years to recover anymore. You have withdrawals coming, required ones, which leads to the fifth problem, required minimum distributions, or RMDs. At age 73, the IRS forces you to start withdrawing money from your 401k, whether you need it or not. Those withdrawals are taxed. They can push you into higher tax brackets. They can increase Medicare premiums. They can trigger more taxes on Social Security. So even if you want to wait, you can't. The government decides when your retirement income starts. That's not freedom. That's delayed obligation. Now let's talk about the psychological trap. 401k's create the illusion of responsibility. You see the balance go up. You feel safe. You stop thinking. But a big number on a screen is not a retirement plan. A retirement plan answers different questions. What happens if inflation stays high for 10 years? What happens if markets underperform? What happens if I live longer than expected? What happens if taxes rise? What happens if healthcare explodes? Most 401k's don't answer those questions. They just postpone them. That's why experts call them time bombs. Not because they always fail, but because they concentrate risk in the future when you're least able to fix mistakes. Now, to be fair, let's say this clearly. A 401k is not useless. The employer match? That's real money. Take it. Tax deferral? Useful in the right strategy. But the danger is treating a 401k as the entire plan. Because retirement is not about accumulation. It's about cash flow, taxes, control, and resilience. The smartest investors don't ask, how big is my 401k? They ask, how many ways can my retirement fail? And have I closed those doors? And that's the shift most people never make. Let's clear this up properly. Because the goal is not to hate the 401k. The goal is to use it correctly, so it works for you, not against you. So first question, how do you use a 401k without turning it into a time bomb? The answer is boring, and that's why most people ignore it. The first rule is this: your 401k should never be your only plan. The moment it becomes the core of your entire retirement, you've concentrated too much risk in one box. Tax risk, market risk, policy risk, timing risk. A 401k works best as one layer, not the foundation. Second rule, take the employer match. Stop there or slow down. The employer match is free money. Always take it. That's a guaranteed return you won't beat anywhere else. But once you've captured the match, blindly maxing out the rest is not always smart. Why? Because after that point, you're locking more money into future unknown tax rates, forced withdrawal rules, limited flexibility. Many people would be better off splitting contributions between 401k up to the match, taxable brokerage, Roth options, other income-producing assets. Flexibility beats optimization. Third rule, don't let your 401k become a pure stock market bet. Target date funds sound safe, but they're not magic. They still assume markets behave normally. As you get closer to retirement, your allocation should reflect time, not age. Money you'll need in the first 5 to 7 years after retirement should not be fully exposed to market crashes. That's how people get wiped out in bad decades. The biggest danger is not volatility, it's being forced to sell at the wrong time. Fourth rule, plan for taxes before you retire, not after. This is huge. If all your retirement money is tax-deferred, you've built a future tax problem, not a future solution. Smart use of a 401k means thinking in buckets. Tax-deferred, tax-free. Taxable that gives you control over when and how you pay taxes later. And that leads us directly to the second question. When do Roth options actually make sense? Short answer, Roth makes sense when taxes today are lower than taxes tomorrow. Long answer, let's break it down. Roth is powerful, but it's not always the right choice. Roth makes sense if you're early in your career, your income is relatively low today, you expect higher earnings later, you believe tax rates will rise, you want tax-free flexibility in retirement with a Roth, you pay tax now, voluntarily, to remove uncertainty later. That's not about saving money today. That's about buying certainty. Roth also makes sense for people who want to avoid RMDs, people who want cleaner estate planning, people who expect long retirements, people who want tax-free withdrawals in market downturns. But Roth is not always smart. Roth often does not make sense if you're already in a high tax bracket, your income is peaking, you expect lower income in retirement. You need the deduction today to survive. Paying taxes now would force you into debt in that case. Traditional contributions can still be logical. Here's the real mistake people make. They treat Roth versus traditional as a religion, not a tool. The smartest investors don't choose one. They build tax diversification. They give themselves options. Because retirement is not about guessing the future correctly. It's about not being trapped by one outcome. So the clean framework looks like this. Use the 401k for employer match, tax deferral when income is high, structured long-term savings. Use Roth for tax diversification, flexibility, protection against future tax hikes. Use taxable accounts for liquidity, opportunity, early access. Control. That combination turns the 401k from a time bomb into a tool. Final truth, and this matters. A 401k is dangerous only when it's used blindly. When it's used intentionally, with limits, balance, and awareness, it can be useful. The problem isn't the account. The problem is the assumption that it's enough. Retirement doesn't fail because people didn't save. It fails because they saved into the wrong structure. What happens if inflation stays high for 10 years? What happens if markets underperform? What happens if I live longer than expected? What happens if taxes rise? What happens if healthcare explodes? Most 401k's don't answer those questions. They just postpone them. That's why experts call them time bombs. Not because they always fail, but because they concentrate risk in the future when you're least able to fix mistakes. Now, to be fair, let's say this clearly. A 401k is not useless. The employer match? That's real money. Take it. Tax deferral? Useful in the right strategy. But the danger is treating a 401k as the entire plan. Because retirement is not about accumulation. It's about cash flow, taxes, control, and resilience. The smartest investors don't ask, how big is my 401k? They ask, how many ways can my retirement fail? And have I closed those doors? And that's the shift most people never make.